Welcome back to the Future Skills Finance course. As always, I'm Mikael Syding. Today I'm going to talk to you about my actual investment method, my strategy, and by that I actually mean my very process of investing. And I'm going to use a model that I call FAMINE for short, and it's filtering the universe, it's analyzing fundamentals, it's financial modeling, investing, and finally evaluating the trade. There will be more detailed notes to this episode, and this video is really just a short guide to these very notes. Alright, let's start with the filtering. You need to have some kind of a universe, a group of stocks that you want to analyze or filter. And this can be a group that you have collected over the years and that you keep constant tab on. It could be a collection of tips from various sources, for example, a broker, a friend, or a taxi driver. It could be based on geography or an industry or size or liquidity of a certain group of stocks. It could actually be your current portfolio or a group of suppliers or competitors, peers to the companies in your current portfolio, and you want to research these further to see if there are any interesting possibilities. So what you want to start with this group, this universe of stocks that we call it, is you want to start by filtering on valuation. That's what I do. There are a lot of various valuation metrics, but a few of the ones that I like the absolute best are price sales, price equity, price book, dividend rate, price cash flow. Actually, cash flow is the most important thing, but it's not always that the price cash flow measure is the best to use. Enterprise value to EBIT, and also the leverage, debt to EBIT or debt to EBITDA. EBIT and EBITDA are just various measures of the result, various measures of earnings before certain items like interest and taxes and depreciation and amortization. And when you filter on these valuations, there are at least 3 ways to do it. One is to filter on an absolute level. So let's say, for example, a price earnings ratio of 15. Another way is to filter on the multiple relative to the company's peers. So for example, if the company you're interested in has a price earnings ratio of 15 and the industry has a price earnings ratio of 18, then your stock is 3 units cheaper than the industry, and that might say something. And finally, you can also filter relative, the price earnings ratio relative to the company's own history. So if the company you are researching has traded in a range of 10 to 15 for, let's say, the PE ratio, then if it's closer to 10, it might be considered cheap. If it's closer to 15, well, at least it's expensive relative to its own history, and that warrants further investigation. Alright, let's move on to a couple of these ratios in detail. Alright, let's get back to the various multiples and look how we can use them in various situations. So, for example, the price sales ratio, that is the number of yearly revenues that together make up the entire value of the company. What you really want to use when you use price sales ratio is really enterprise value to sales ratio to take into account the level of debt. But I will use price sales ratio as a shorthand. And you really need a long history to be able to use the price-sales ratio. The strength of the PS quota is that it takes out the problem of cyclical margins out of the equation. And for example, if the price-sales ratio usually is between 1 and 3, then if it's closer to one of the extremes, that could signal extreme conditions. And it's not certain that a low price sales ratio is cheap or high is expensive. What it does say is that currently the market is seeing something, it's sensing something, maybe it's fearing something, which could be signaled by a low multiple, or it's hoping for something. And maybe there are players in the market that actually know something, so you really need to keep a lookout for that. My remedy to this is that I often filter companies according to if they are mid-range of their multiple. Then we can move on to the price-earnings ratio. This is what most people use most of the time, and the reason is that it's so intuitive. It really just says how many earnings, how many annual earnings, that is, how many years will it take for the company to create the kind of value that you are paying for the company. Just remember that margins are often cyclical. They can be cyclical according to where the company is in its product life cycle. So if they launch new products regularly, then that can create temporary bumps in profitability. It can also be a question of the economic cycle affecting margins positively and negatively over a cycle. And there can also be one-offs, just temporary stuff that has created a boost or a bust in the earnings of the company. And these things, they make just single year earnings a less reliable metric for the earnings power of a company, and that's where the price sales ratio come in instead. So if you have a long history of sales and earnings, then you can look to that instead. And finally, for this episode, the price book ratio. The price book ratio is very good for example, banks, where the book, the equity, the actual amount of capital and money ready for the banks to produce value is also exactly what does produce the income. So banks use their capital with leverage to lend out and make a margin on the lending. So you could say that the equity is the engine that creates the value in a bank, and therefore a price book multiple is a good metric of over the cycle what a bank should be valued at. After applying this valuation filter, and there are many other valuation metrics you can use, and you can use multiple filters for the same company, of course. That's really what I do. I use several of these to triangulate what I think is the intrinsic value. Anyway, after applying the filter, I'd like to go deeper into the fundamentals, and this brings us to what I call value drivers. So value drivers is what the company is really all about. What are they creating? What's their unique capabilities? What are their key products, like the iPhone, for example, for Apple? And is there a warranted or an unwarranted hype surrounding the company? So some things may appear to be value drivers, but they really aren't. It could be just temporary things. So what you want to do is try to find something fundamental about the company that explains why why it appeared in your filter. Why is it extremely cheap or expensive, for example, compared to its peers or its own history or the markets, or however you choose to apply your filters. Maybe there is some new competition. There could be various leading indicators, such as in banks, for example. There is a term called delinquencies, which just says how early or late clients are with paying back their debts and interest. And if they are late, this shows up as delinquencies, which about 3 months later show up in actual credit losses. And not many investors look at delinquencies, at least not private investors. And this was actually instrumental for one of the big killings that my fund made in 2008, where we were watching delinquencies very closely in a few Baltic countries. And this turned out to be a very good metric to be a couple of months ahead of the ensuing financial crisis. Other fundamental drivers might be demographical trends, how the population is moving, undulating between the age categories, and that could be drivers of demand, drivers of taste. And finally, various macro variables could also be important drivers for funeral agencies, for example, or diaper manufacturers. So keep a lookout for various macro trends, including policy. Thank you.